Great. So today we are joined by Nina of the Maine Venture Fund and Chandler of Coastal Ventures. I want to thank you both for donating your time for this workshop today, and I'll pass it over to you to get things started.
Great. I'll kick it off. My name is Chandler Jones, and I am co-managing director of CEI Ventures. CEI's venture capital subsidiary. We're a for-profit subsidiary of the nonprofit CEI. We were founded in 1994 and have raised 5 funds that focus on CEI's mission for growing jobs, supporting companies that promote environmental sustainability and what we consider shared prosperity.
Great. And my name is Nina Skeepers. I'm a principal at the Maine Venture Fund. We are a state-sponsored venture fund focused on investing only in Maine-based businesses. And like a little bit like CVI, we have a dual focus. We're also we have an impact focus on driving economic development in the state. So also making sure that our investments are contributing high quality jobs and contributing towards thriving communities here in the state of Maine. So hopefully, as you all know, today we're doing a little workshop on venture capital, and this is the third, I believe the third, I didn't participate in the other two, in a series focused on friends and family investing and angel investing. And so today we're talking specifically about venture capital and venture funds. So we, Chandler and I, will do our best to demystify a little bit what venture capital is, what businesses are a good fit for pursuing equity investment, and how our respective funds think about investing and what businesses are good fits for our funds. So that's the goal for today. Hopefully that's what you all thought we were going to be talking about today. And just one more thought from my end before we dive in. I think as someone who's relatively new to the equity investing space, it's a really niche way to fund your business. And it can be pretty opaque and hard to understand. At least that was my experience coming into this world. And so this is just a plug to say, don't be shy with questions. A lot of this can be hard to understand the first time. And even when you're in the industry, it can be confusing and complex. So ask whatever questions you have. It's a relatively small group. Chandler and I only have 5 slides to share. So there will definitely need to be discussion and conversation from the group to make this a good session. So ask whatever questions you guys have. And with that, I'll hand it over to Chandler to get us started. And I think, Rachel, we can move to the next slide.
Great. Thanks, Nina. So what is venture capital? At a very basic level, we invest in early stage companies in exchange for part ownership. So if you go to a lender to seek a loan, you may receive capital. You pay that capital back over time through monthly payments or quarterly payments. We're different in that we actually seek to buy a piece of your company, grow with you, hopefully provide technical assistance or advisory services along the way. Often we join the board of directors if there's a board of directors, and try to mentor the entrepreneurs as they grow. And then eventually, as the company grows to a certain point, we hope to, sell our ownership in the company and make a profit on it. So that's venture capital at the most basic level. Rachel, why don't you skip to the next slide, and I can go into a little bit more detail on what the type of companies we look for. There we go. So again, investing in early stage companies for part ownership. We're looking at businesses that are seeking to grow rapidly. So big growth ambitions, companies that are scalable, often higher margin businesses or businesses that have a proprietary service or product. And then, that can grow and create an exit opportunity, what we consider an exit opportunity, where or we can sell our ownership in the company either to a strategic acquirer, in some cases back to management, or, you know, in the rare instance, the company goes public and actually becomes a publicly traded business. So that's, you know, what's not a good fit for venture capital is a company that might be a lifestyle business, a company that you know, the entrepreneur tends to or wants to hold on to for 30 years, and then pass down to their children. You know, we're looking for higher growth, scalable businesses, and opportunities to you know, exit over a 5 to 7 to 10 year time horizon. Nina, you want to pick up the?
Yeah, I'll take benefits and drawbacks. So if you're thinking about raising equity to help your business scale and grow, that fundamental structure of selling part ownership in your business has some great benefits that are quite exciting for someone looking to grow their business, but they also come with some structures that can be real drawbacks to, or for some entrepreneurs can be real drawbacks. So it's really important to understand what those are to make a good assessment of whether an equity fundraise is the right way for you to fund and grow your business, versus, you know, considering loans or bootstrapping or other mechanisms. So first, this one's always exciting. Unlike debt, there are no monthly payments, right? So you're selling part ownership in your business, and like Chandler described, the investor is going to make a return or not make a return when you sell or exit the business, right? So there's no expectation for any payments to equity investors in the near term. And that can be a real benefit, right? Because all the money you raise, you can put into growth and marketing and sales to grow your business in the near term. Second, most VCs or institutional investors, again, like Chandler described, will require that you put together a board. Since the investors are now part owners of your company, there's expectations about shared decision-making and working closely with those investors moving forward on big, important decisions. And so putting together a board is a big part of that effort for shared decision-making moving forward. That can be really great because that board in the benefits bucket often brings really good operational or financial experience and can help you grow and accelerate the company, you know, maybe more than you would have been able to do on your own. But it also comes with the drawbacks of that governance structure and having to manage the board and report to the board. And that can be quite a bit of overhead and legwork to create that structure and to make it effective. Ideally, if you have a really well-functioning board, it's an accelerant to your company, but you have to be willing and excited about sharing that decision-making authority with other folks who are now part owners in your company. And this is getting into a little bit into the weeds, but boards, most investors want what we call balance boards. So we're looking to have representation from both common shareholders, i.e. employees, founders, and preferred shareholders, which are the investors investing in the company, as well as some independent representation, which can be a lot of things, but it's usually someone with really good industry expertise in the industry you're looking to grow in. So governance, a really big part of raising equity investment. It has a lot of benefits and some potential drawbacks when it comes to managing the board and that shared decision-making piece. there's also a lot of reporting. Once you have shareholders, you got to, report to them. They expect to be kept up to date. And that can look a lot of different ways, but at a baseline, there's, usually monthly or quarterly financial statements. Investors want to know what your plans are. So there's usually some sort of management report. That can be a drawback because it's a lot of work, but ideally good reporting, right? Good financial structures can really help a business in the long term grow and be successful. And what am I missing here? I'm doing these all out of order, but lastly, right, a benefit of equity fundraising is that you can raise a pretty good sum of money. If a business with somewhat limited revenues or assets, but a really good idea and a really good plan and a really stellar team, if that team goes to a bank, they'll probably walk away with no loan at all, right? Like they're probably not going to be able to get capital from a bank. But that same company will probably be able to raise $1 million from equity investors, right? So if you are able to find investors who like what you're doing, are excited about the potential, the traction, the trajectory of your company, you can raise a good amount of funding to help you grow. On the drawback side, that equity fundraise can take a lot of time and effort, right? So it can be almost a full-time job for a CEO for 3, 6, 9 months to be able to reach out to all the right investors, make all the connections, and ultimately close that fundraise. So that's a lot of benefits and drawbacks. Hopefully some of those resonate with you guys. But I think the important thing is to think about, right, how do you want to grow your business? And how does the structure and these benefits and drawbacks fit into and align with your goals or not, right? And that'll help you understand whether it's the right mechanism for funding your business or not. Any questions?
I might just add one other point, that venture capital typically is considered, the most expensive form of capital, in that you're giving up a piece of your company and the future growth in your business. However, if your business is a high growth company, and maybe you can't seek debt financing because you don't have the collateral base or the cash flow to be able to support repaying the debt, it may be, your only option, and you're gaining a partner in many cases. Nina and I generally think of each other as partners to the entrepreneurs we work with. We stand by, willing to support the companies through successive rounds of capital raising. So while you give up, you may give up, something on the front or on the back end. Hopefully you gain something, along the journey that you're going on.
Great. Questions? Great. I think we can move.
It looks like Sean might be trying to ask a question. Sean, if you are, we can't hear you, unfortunately. So do you want to try again or pop something in the chat? We can't hear you. Yeah. Are you able to put something in the chat? Maybe give me a thumbs up if you can.
Reasonable rate of return for an equity investment. Sorry, different question, not Sean's question, Jessica's question. Chandler, do you want to take that one?
Yeah, that's a good question. So usually when we make an investment, we look at a minimum of a 30% return, internal rate of return. So that's time-based. And that's, it doesn't always work out that way, because our capital is at risk, and so if the business fails, we don't have any recourse like a lender would. Internal rate of return is is a formula based on the time that it takes, and then the capital return over time. So it's time based, in other words, without getting too detailed, but it's essentially the annual rate of return that you would receive on your investment. So a 30% per annum return.
And then Sean's question is, and Chandler, maybe you can take this one too. What formula do you use to determine a valuation of a company?
Yeah, and that's a little bit more, that's a trickier answer. The valuation is highly dependent on the growth of, the how fast the company's growing, comparables in the, to competitors, either public comparables or private M&A in the market, and it's really industry dependent. So for instance, if you're a fast growing software company, maybe you would use a multiple of revenue to value the company. If it's a company that is more, maybe slower growth, but spits off a lot of cash flow, maybe you'd use a multiple of EBITDA or earnings before depreciation, interest, or earnings before taxes, interest, depreciation, amortization, to determine the valuation. So it's highly dependent on the business and the industry. But if you want, I could be happy to take that one offline and help any way I can.
Great. And then I think we have one more question about, also from Sean. I have a large revolving line of credit. Does the VC replace the bank? And I would say not always, or ideally not, right? A lot of the companies we work with will take equity. Ideally, the equity is going towards growth, right? And not paying off some other debt. And a lot of the companies we work with still have line of credits to help, whether it's seasonality or there's a lot of different factors that might make a line of credit still relevant to a business, even if they have equity on their cap table. Chandler, what would you add?
No, I think that sums it up. I mean, generally, venture capital, the investor wants to put the money into the company to fuel growth, and so that's usually the use, and not replacing bank debt. And again, the venture capital money is more expensive in the long run, and so my advice is usually to either stick with the bank debt as long as you can, or seek a lender because it's cheaper. And if the company is in the stage where it's growing rapidly, maybe you don't have the collateral or the cash flow, then VC may be your best option. Sean, I'll have Sarah send my email if you'd like to catch up. I'd be happy to help.
Great. Those are all really great questions. Any other questions from the group? Great. Rachel, I think we can move to the next slide, and I'm gonna just continue to talk here for a second, and then I'll give it back to Chandler. So some of you might be considering like, hey, at what stage am I a good fit for venture capital? And there are a lot of different factors, and there's no one right answer. Some businesses raise venture capital pretty quickly. Some businesses, take a couple of years before they consider raising venture capital. But generally speaking, venture funds get involved after you've probably raised some equity capital from friends and family or from angels. And that's largely because most venture funds are looking for what we call product market fit. And basically, right, like you have a product or something you're selling, and there is a consumer on the other side that is excited about buying that thing. And the easiest way for VCs to know that there is product market fit is for there to be some early revenues that are growing really rapidly. So most VCs will look for that. There are some venture capital firms that will invest earlier. They're usually, they call themselves pre-seed investors. They might look at you before you have revenues, but by and large, some early revenues and like a pretty good growth rate, I think makes you more attractive to the average VC. VCs are also looking for a really solid team. And so most folks, not to say you can't be a solo founder, but it's always encouraging to see, some co-founders that have complementary skill sets and are building a team around them that fill in the gaps that co-founding team doesn't have. So most investors are looking for a really strong team that can execute the plan or the idea that they're working towards. And then that last bullet is a believable plan with clear milestones, right? So like Chandler just said, VCs are looking to invest in growth. And so they want to know, hey, if we give you $1 million, what are you going to do with that? How are you going to invest that money in your business? And what are the milestones you're going to achieve that get you to the next level? Whether that is, right, another round of VC funding or an acquisition, what is the plan and how are you moving towards that? And how does the money help accelerate your growth towards those milestones? Mm-hmm. Chandler, do you want to talk a little bit about how CVI, like anything specific to CVI, and then I can talk about MVF afterwards?
Yeah, sure. So CI Ventures, and just to be clear, we raise these funds, they're 10-year funds, and we may do between 12 and 15 investments in each fund, and reserve capital for, like I said earlier, to follow on in successive capital raises, because we all know that growing companies, and all companies really, it may take longer and cost a little bit more money than what was originally budgeted. So we do reserve capital for additional investment over time. But we generally come in, maybe when the business is doing $1 million in revenue, maybe it's a little higher than that, depending on the company, the industry, and the growth profile. And then, our minimum investment size is usually around 500,000. There's no hard and fast rule there, but and our maximum investment is around 2 million. And again, reserving some capital for follow-ons, over the investment period. And then, I think it's important to think about when you talk about stage, and also, the clear milestones that Nina just mentioned. We're heavily reliant on their entrepreneurs. So we spend quite a bit of time getting to know them before we actually, place an investment. And so, we do really want people that we can trust. We want, projections and business plans and clear milestones that we can understand, because we're investors. We try to help, and we see a lot of general information across our portfolios. But at the end of the day, the entrepreneurs are the experts, and we're extremely reliant on their capability to lead the company.
Great. On MBF side, we have two ways we invest funds. So we talk about our core investments. Those are maybe a little bit earlier stage than what Chandler just described, but we're generally looking for companies with some strong scaling revenues, and looking to grow pretty aggressively. And in those situations, we invest somewhere between $100,000 and $300,000 as a first investment. And similar to Chandler, we're looking to follow on. So ideally that company does really well and we continue to invest over time. But 100 to 300K as a first check. And then we also have a micro fund program. And that is specifically for businesses that are pre-revenue to help those businesses get to market. So I just said most VCs look for revenues to make a first investment, but our microfund program is really targeted to help entrepreneurs get to market. And so it's okay if they're still pre-revenue. I will say that we invest only in what we think about as like the highest potential companies or ideas with our microfund, because it is so much riskier to invest before there are any revenues. So but that said, it can be a great program for entrepreneurs who have a really good idea, are close to getting to market, but need some additional capital to get there. And so two different ways, our core investments and our microfund program. And I'm happy to share more information about those two paths after the call, if anyone's interested. Any questions about, when is my business ready for VC capital, or how CVI or MBF invests?
Nina, I'm just going to put you on the spot actually with a question. I think that mention of the micro fund could really pique the interest of a lot of folks. So I'm wondering if there's an example you can share, either naming the business or not, of a company that you invested in that was pre-revenue. They weren't generating any revenue yet, but that felt like a good fit for that fund, because that's just a huge bucket, right?
Yeah.
A pre-revenue business. So can you give an example there?
Yeah. So the microfund's relatively new for us. We launched it in like the middle of last year. So I think we've only made a couple of microfund investments, but the one that I'll talk about, and they're on our website, so you guys can go click and look at the company. It's called the Maine-based. It's a really cool company looking to help adults continue to stay curious. And so Lauren, the founder, built this really cool app that has these different, I think about it as like an interactive podcast. So it has these different modules that you can go learn about space or about nature. And there's all these curated experiences, and it's a really cool app. She has a really awesome newsletter. So this is also a plug to just go subscribe to the Maine-based. But the reason it was a good fit for the microfund is because Lauren had more or less built this whole app. She had all these experiences ready. It was a matter of a couple of months before they were ready to launch, and she needed capital to get the app into the app store and then to drive sales, right? And so I think the thing that made it a good fit is that the idea was pretty well founded. She had a lot of engagement with her content already through the website and through a newsletter. And so she was able to demonstrate, hey, there is some product market fit here. And I really just need capital to get this thing launched and over the finish line and then drive sales. So does that, Sarah, give a good example, right? I think the piece was that she was really close to getting to market, and she just needed some capital to get there.
Yeah. And is there a range for the investment in those micro funds generally, or in that micro fund?
Yes, sorry, I should have mentioned that. So 25 to 50K is the investment check. So quite a bit smaller than our core funds.
Wonderful. We do have a question from Alma.
Yes, hi. I have a question. We are starting a design agency, like digital and service design. Have you ever seen an example where VCs have invested in a design agency? Since we want to have a bigger reach, helping other tech companies grow as far as their experience design offerings go. Have you ever seen an example like that? I would be curious to know.
Chandler, do you want to take this one?
Well, you know, I don't know enough about the business, I think, to give you an apples to apples, you know, example. But I think all different businesses get funded by venture capitalists. And so really it's a matter of, you know, having, you know, something that would provide a strategic advantage to you and your business, you know, having the growth profile that would fit within the thesis of, you know, a venture capitalist. So you know, I wouldn't, like, you know, I would think that there probably are examples out there. You know, we have digital marketing agencies. It's not exactly the same, but there are several you know, examples that may be sort of you know, similar to what you're doing.
If it is okay for me to ask a follow-up, when you're investing in a digital marketing agency, what sort of exit are you looking for as far as an investor goes?
Yeah, so generally, what we, you know, we look at a sale to strategic you know, a strategic acquirer as the most likely scenario for most of our businesses. And so that would be, you know, maybe selling to a larger agency, or somebody who wants to, you know, depending on what facet of marketing that business is in, somebody who wants to acquire a business that has the expertise, you know, in the book of business that comes with that company.
Thank you.
Mm-hmm.
The one thing I'll add is we often think about, and this again to Chandler's point, is it's hard to generalize, but services businesses are usually not super scalable, right? And you got to grow your people. You got to grow your number of employees a lot to be able to service more clients. And so businesses that are service businesses usually or more often are not a good fit for VC. Usually we're thinking about how is this business scalable enough for it to have an attractive exit for us. So that's maybe another way you can think about it, Alma, is like, is this a services business, or is there some sort of platform play where I can serve a lot of clients without growing, without needing a person to service every one of those clients?
Mm-hmm.
A couple more questions in the chat. Are there more venture fund organizations in case MVF or CVI aren't a good fit? Yeah, there are a lot of VC funds. There really aren't that many in Maine. But there are organizations like the Maine Angels, which is a cohort of angel investors that can be good to reach out to. And there are lots of venture funds if you open the scope to include Northern New England, right? The moment you look at Boston, there are lots of funds. And I think the thing you bring up, Charles, in here is I want to make sure that I get the most, right, like the right VC to bring the right skill set to my team. I think that's a super important thought and perspective. And I think it's in one of our slides later, right? You want to find a VC that brings industry experience or whose mission aligned with what you're doing. To the extent you can find a VC that is interested in what you're doing, whether it's industry or mission or whatever, I think it increases the likelihood that they'll be interested. And to your point, they'll bring more value to your team to help you, whether it's at the board level or just as in an advisor capacity, continue to grow and scale your business. Chandler, anything else you'd add there?
No, I think that was
And
good.
then one more question. Does the micro investment also involve an equity stake? So great question. And this is something that Chandler and I avoided putting in the slides because it can get very technical very quickly. But there's two ways to take on equity investment. The first is probably the way most of you guys think about it. It involves a valuation. We call it a priced round. And when the investor gives you cash in exchange, they get a percentage of your company. The other way to take on investment is something called a convertible note. And that is in the short term, it sits on your balance sheet like a loan, like debt. But the expectation is that that note converts into equity at the next fundraise. And that is pretty complicated, and maybe that doesn't make sense yet. So happy to talk about that more, but our microfund investments are convertible notes. And so I think, Jessica, you asked the question. It's not a priced round, but the expectation is that it will convert into equity at your next priced fundraise.
Yeah, maybe if we, Sean has a question, but if we move to the next slide, we have a list of companies. And I can provide an example of what Nina just mentioned based on how we've done some of these investments in the past. So you'll see it. You see on your right that with the CVI emblem. These are examples of several of our portfolio companies, and then in the middle of the Venn diagram, there are some common investments between the Maine Venture Fund and CI Ventures. So I think, Tilson Technology is an example of an investment we made probably 10 years ago. And I'm just going to throw out like hypothetical numbers to create an example here. But say Tilson Technology was at the time was doing, $5 million in sales. We negotiated a valuation with them and had a certain dollar amount that we invested. And so if we negotiated a $10 million valuation and invested $1 million, we bought about 10% of the company. Say the company grows to $100 million in sales, so 10 times what we invested in. The valuation that we invested in, or let's say it grows to $100 million in value, not sales, then and sells for $100 million, then our 10% ownership is now worth 10 times what we invested. So it's now worth $10 million. And so that's where we make our profit. And as Sarah and Nina know, it doesn't always work out like that. And there are often situations where we might be lucky to just get our investment back, or we lose our investment. And so, from the venture capital fund standpoint, we need those investments that make a super high return to make up for the other investments that don't work out. And in our case, we do have a social mission for creating good jobs and promoting environmental sustainability. So, we're looking at a number of different factors when we make our investments. We're looking at job quality. We're looking at the products and services to see if, they're using, sustainable ingredients or inputs. And so, there are a number of different factors that go into, our investment decisions beyond just, purely profit. Another example, based on the convertible note that Nina had just mentioned might be, let's see, it's a good one here. I'll just pick one, but Blue Trace, for instance, say that company was raising money. They were not ready to raise what Nina had just referred to as a price round. So they weren't ready to put a valuation on the company. Maybe they were young, and had lots of potential. And because they were so young, the founder didn't want to sell a big piece of the company because there are really no sales to demonstrate the future growth. So he, might negotiate a convertible note with the investor. And in that case, it kind of pushes the valuation question off to a later date. But the investor is going to expect that at some point, there will be a trigger to convert that investment plus interest and possibly a discount or a step up in value to the next financing, the equity financing that happens. So again, we're like, it gets really complicated quickly. But there are generally two different structures that we use. The first being equity, and the second one being a convertible note, which is basically just a loan that has the expectation that it will convert into equity at a future date. Again, just running through a couple more of the companies we've done. OG, and we're Maine centric, but we're not totally Maine, 100% Maine based with our investments. So OG is a skincare company in Vermont using natural and organic, creating natural and organic skincare products. 88 Acres is a company that's making allergen-free snacks, butters, and granolas. So taking nuts out of energy bars and butters. Really interesting company. I was just down there yesterday. They're based in Canton, Massachusetts. Rockstep Solutions is a software company for diagnostic testing in the drug discovery phase of pharmaceutical development. And Our People is a platform for the deskless worker so that companies can communicate with their employees if they're not near a computer regularly.
Great. A couple more questions in the chat. Sean asked, is there an opportunity to hire you to consult and structure the sale of a business instead of having a smaller equity stake? I can take that one. So, like if you're just looking for a consultant to help you sell your business, there are organizations that help do that, help either broker or identify potential organizations that might be interested in buying your company. I don't think MVF or CVI does that, but I do know a couple of those people. So if you are interested in those contacts, I'm happy to connect you with them. And I bet Chandler does too. So I'm happy to help there, Sean. Chandler, I'll pose this one to you. Is there a way we can join CVI or MVF so that we can be part of the pool of capital that gets invested into businesses?
Mm-hmm. So we raise, as I mentioned, we raise these funds. We seek investment from a range of different investors. Our last fund had, I think, 46 investors, and they were predominantly community banks in Maine, New Hampshire, Massachusetts, as well as some regional banks. But we also have a number of individuals who have invested in the funds. And some other organizations like CEI, FAME, and some other quasi-governmental organizations who have put money in. Yeah, go ahead, Sarah.
Oh, I just wanted to add to your really good answer that more commonly individuals act as angel investors rather than joining a venture fund. to be an angel investor, you have to be what's called an accredited investor through the SEC, the Securities and Exchange Commission. And you have to meet a certain threshold of assets and income. And that's meant to protect individuals from making what are these really risky investments and losing their net worth, right? Essentially kind of losing it all. And so that, that would probably be a first avenue to explore if you were interested in becoming an investor in companies like these. First, to Google SEC accredited investor and see if you meet that threshold. And then if you do, you could have a conversation with Maine Angels about joining their group.
Yeah,
You
thanks,
don't
Sarah.
want to upset the SEC.
No, and our investors need to be accredited as well. So thank you for pointing out the disclaimer there that I missed. But but angel investing is a great way to get exposure to some of these businesses and get to understand the industry.
And I'll just quickly add that MVF we're state sponsored, so we only invest state funds, and we do not have any they're called LPs, limited partners, so we don't have any private investors beyond the state. Another good question, how often does the company buy itself back from a VC? Does the company have a say over whether that happens or not, or do they lose control over that portion of the company if the VC is planning to move on? So that's a really good question. Most venture funds are buying minority stakes in companies. So usually, especially when we're investing for the first time, the founders or the folks who started the business oftentimes continue to own 50, 60, 70% of the company, and investors are still a small portion of the overall cap table. And that said, there's still, those shared decision-making pieces. So there's things that you need board approval on, or there's things that you need all your shareholders to vote on and approve on. So there is a level of shared decision-making. But ultimately, VCs, like Chandler just mentioned earlier, are investing in the entrepreneur to continue to grow the company, and investing in that person's skill set to be able to execute the vision they've laid out that got them investment in the first place. So I wouldn't say, like you lose control over a portion of your company. I think there's just shared decision-making over the whole business. And then to the first part of the question, which is, can the company buy itself back from the VC? I do think that occasionally happens, and Chandler has probably seen that more than I have. Generally, like we're looking for, it's more common for the company to sell as a way to buy themselves out and to buy out investors, but there can be structures created where the company pays back the investor plus some return over time if there becomes a situation where they're not likely to sell.
Mm-hmm.
So
yeah.
Chandler, what would you add?
Well, no, I think that was, generally it's not the exit that we anticipate at the beginning of our investment period. Generally, like I said, we're looking for the companies to grow and potentially become acquired by a strategic acquirer who sees a lot of value in that business, so they may be willing to pay more. The buyback happens, and usually there are some mechanisms in the documents to allow that to happen, but it's more a way of saying, okay, well, we've given this a try. It's been great working with you, but it's time for us to seek a way to get out, and maybe you want to buy our stock back, but it doesn't usually generate the premium return that the venture capitalists are seeking. hopefully that helps.
Great. And I'll maybe, I'm trying to think of if it's worth talking. So on the left side of this slide, you'll see a couple of MVF's portfolio companies. Maybe the one thing I'll talk about on this slide is, since this is right, women's business centers, the one thing, right, if you're out there looking at big VC stats, you'll know that only 2% of all venture capital deployed in the greater US or maybe worldwide gets deployed into female-led businesses. So that is a pretty horrendous stat. It makes me mad personally. But that said, in the state of Maine, I think things skew a little bit differently. So just coincidentally, these are just random companies we picked, but I think of the 1, 2, 3, 4, 5, 6, 7, 8, 9 companies on there, all but 3 are women-led companies on the MVF side. So things look a little bit better if you're pursuing funding from MVF, and I think CVI has similar stats. I think in 2022, 45% of the capital we deployed went to women-led businesses, which isn't quite 50%, but definitely way better than the national average. So that's my little plug about, yeah, the stats nationally aren't great, but doesn't mean that you shouldn't be out there as a woman-led company looking for VC funding, because there is funding for you to help you grow your business.
Mm-hmm. Great. Yeah. And Jillian, the Maine Angels are a great place to start. And we are also members of the Maine Angels, and we have that membership to help us get acquainted with businesses, as they go through the process. So it helps us with deal flow. So if you'd like to chat just to open the conversation, happy to do so. And then Charles, C corps are definitely preferred to LLCs. S corps are disallow investment from a for-profit entity like a CEI venture. So that's not something that we could do. LLCs are okay, but they can be problematic due to the pass-through income for at least a venture fund like ours.
And I think the other question there from Charles is when it comes to the board about how big should we aim for? So generally what we see is if a company's pretty early stage, they'll maybe put together a 3-person board. And again, it's that balanced structure of 1 representative of common employees and founders, 1 representative from preferred, i.e. investors or note holders, and 1 independent. And then as the company grows, we often see that grow to 5 people. And there definitely are companies that grow beyond 5 at some point, but I think 5 is probably the standard number for a board. Is that fair, Chandler?
Yeah. Yep.
Great. Any other questions? I think we're moving to our last slide. And Rachel, you can move us forward, maybe 1 more, and I can talk through these, but any other questions? You guys have asked great questions so far. Great. So leaving you guys with a couple of next steps here, or food for thought, if you're thinking about, if you've gone through this hour and you're like, yeah, I think I do want to raise some equity capital, despite all the horrible things that Nina and Chandler said. The really 4 pieces of advice or thoughts for you guys. So start to think on a 3-year plan and think about where in that frame VC funding might fit in. A lot of VCs want to get to know you, like Chandler mentioned. So it might take 3, 6 months, maybe even a year, building a relationship with a set of venture funds in order to be able to raise your round. So think a little bit longer term, think about the growth you're trying to get over that horizon, and start to build relationships with folks that you think might be interested in investing in your business. And that gets us to the second bullet point, which is, I can't remember who asked this question, but right, find a fund that is aligned with what you're doing, right? Whether it's industry or values or mission, the more you can identify funds that already have some sort of interest, predetermined interest in what you're doing, it can really help you build that relationship, get a conversation, get them interested in what you're building. And I think it will lead to a better long-term relationship, right? If they're an industry expert, or they align with your mission and your values, I think that leads to a better long-term relationship. This is maybe my favorite, and I didn't bring my book down from downstairs, but number 3 is my favorite piece of advice. There's this book called Venture Deals by Brad Feldman. It's a really good read. It's a good book. It's funny. He's funny. And it provides a really great basic framework of venture capital. It goes into things like convertible notes versus priced rounds. It talks you through all the terms. And so it'll just help you better understand the space and be better positioned to be able to approach a VC or have conversations, and know what you're getting into if you raise equity capital. And then the fourth one, lawyers are expensive, but they're really helpful. And so to the extent you are getting serious about raising equity capital, having an attorney who understands securities law and just as importantly, works primarily with startups raising equity funding, can be really helpful. It's really helpful to have someone on your side helping you understand all the paperwork raising equity capital comes with like 150 stack of paper, 150 pages of paper. So having someone who can help you understand what all those things mean and can help advocate for you is really helpful too.
Mm-hmm.
So Chandler, what things should we have put on this list that we forgot to?
Yeah, I mean, I think it's important, start having the conversations, as Nina mentioned, the first bullet point, and then I just, reiterate what you just mentioned about how, having an attorney, to help you through the process. I mean, Nina and I are I think we're good people. We're not trying to swindle anybody or do anything, nefarious, but we are, when we negotiate the investments, we are sort of at the other side of the table. And so, I do get a lot of companies that, ask me, what should I do? And I said, well, we're sort of, I can't really advise you on that because, we're at the other side. But we try to help as much as we can, but it's really important to have some representation by an attorney or or an accountant who understands this type of thing.
Chandler or Nina, can you just speak to when somebody might engage a lawyer? I'm guessing that most folks don't need to leave this workshop today and engage an attorney. Maybe you could just clarify like when in the process that becomes really important.
Oh, well, the earlier question about LLC, S Corp, C Corp, it was a good one. And usually when you're incorporating, your attorney may ask, do you plan on raising, outside capital or venture capital, or angel investment, and at which point he may advise you to become a C Corp. If you're planning on only having you and your partner, or maybe a couple of individuals involved in the company, then it may maybe an LLC. But usually at that point, you decide whether you're gonna go down the venture capital track. So it can start very early, but I would say that if you're considering it, I would at least start shopping for attorneys that are schooled in that in securities law. And then, you know, it doesn't necessarily mean that you have to go and start putting together documents, but I would start thinking about, if you're serious about it, I would start thinking about looking for an attorney who understands, you know, the ins and outs of raising capital. Nina, would you?
Yeah, I think that's fair, right? I think the piece we're talking about is there can be something about how you create like the articles of your company, right? That you might need to engage an attorney on, and you might do that early, or right? You're like, I think this is what I want to do. I need to be a C Corp. I'm gonna put those wheels in motion. And I think much like a VC, you want a good relationship with your lawyer. So the longer you know them, probably the better. But Sarah, to your point, if you're sitting here being like, hey, in my 3-year plan, I think, you know, 2 years from now, I'll be in a good place to raise venture capital. You probably don't, your initial next step is probably not find a lawyer, but you might want to do that with a little bit of runway. Yeah, probably as you start contacting VCs, you also want to make sure that you have a lawyer in your court.
Mm-hmm.
Any other questions? Sarah and Rachel, anything you guys thought we would touch on or talk about that we just missed?
I think this has been really helpful and informative. I do want to give one more opportunity for anybody in attendance today to ask another question, but certainly appreciate you two answering a lot of questions throughout the workshop today. That can be really helpful and was really helpful.
Yeah, all great questions.
Great. Rachel, I think it's back to you, unless Nina or Chandler, you have any closing thoughts, but you have done an excellent job, so thank you.
Yeah, thank you, Nina and Chandler. That was a lot of information, but that was really helpful. And thank you everyone who asked questions today. I think that really helped everybody figure out venture capital funds. So I appreciate that. And thank you for joining us today. You will receive the recording and the materials, the presentation that was shared, in a follow-up email in just a few minutes. So thank you everyone for being here today. Thank you again to Nina and Chandler for your time. Thank you all.
Thanks
Have a
all.
great afternoon.